Good day and welcome to the Kerner Perspective Offshore Portfolio Commentary for the 6 months to the end of June 2025. Because this is so late, we're also then going to bring it up to date to sort of the end of August or 20th of August. Right, just looking at some of the changes we've made in the last while. Not too much activity, in large part because US markets have been, we believe, to be fairly fully valued. And as such, haven't really seen a lot of opportunity, although arguably there was, after Liberation Day, but that was also difficult to call because obviously Trump backtracked quite quickly. But a few of the newer holdings, we'll discuss the first two on that list, Universal Music Group and PayPal, in a little while. Very recent acquisitions, particularly PayPal. Diageo was a new holding for some clients, but many have held them for some time, as we'll discuss. Then Dell for a couple of clients with more technology appetite, and then the China ETF. And of course, we've added obviously to client portfolios where they new portfolios or significant amounts of cash have come in. We would have added to sort of core holdings, but those are some of the bigger changes in the 6 months. And then over the last year or 6 months, we've reduced some of the overweight positions in things like Microsoft, HSBC, and JP Morgan. And obviously with Micron having run hard, in spite of quite a lot of volatility in the model, we trimmed that as well as Shell, but we'll see all of those prices in a little while. So these holdings are largely sort of modeled around typical client holdings. So the biggest position in most client portfolios is HSBC. We've held it for quite a long time. The investment hypothesis was fairly simple. It was sort of an emerging market oriented bank with good fundamentals. For quite a long time, it didn't do much. Here, obviously, we are looking, particularly in the financials, at a very low comparative because of COVID's lows, but really encouraging to see that the share price has come from around £3 all the way up to almost £10 in the space of the last 5 years. And although it did nothing for a while, it's really gratifying to see it performing more recently. And I think in part it's really because I think the market was ignoring the good news. And I think you'll see this in all the banks and in quite a few of the shares we're going to discuss. You'll see that 2020 and 2021, to a degree, earnings, all of them, the EPS, which on all these graphs will be the blue bar, obviously hurt by COVID-19. But you've seen a good strong trend in the earnings over the last decade or so. You've had compound annual earnings growth, which we commonly refer to as CAGR, EPS growth of around 8%. So not spectacular, but really deserving of a better rating than the market was putting them on maybe 6 years ago. So we've seen a nice acceleration of those COVID lows, and as you can see, generally trading or trending around that, or earnings generally tracking that trend line. And there you can see the earnings per share and both the dividend per share looking quite solid, although arguably the DPS somewhat trailing, if you want to call it that, the earnings per share. Obviously, HSBC, we've said this before, they report in dollars, but they are listed in the UK in pounds. When you look at those earnings of $1.40, obviously it translates into a little over £1. So you're still sitting on a PE of under 10 times, and with a dividend of over 60 US cents, call it around 50 in pence, you're again looking at a dividend yield of 5%. So the fundamentals look good, and it's been very gratifying to see this one recover, although it's by no means cheap if you look at it relative to book, but more importantly, just on a PE basis. Then the other big holding, JP Morgan Chase, and although HSBC has been held for a very long time, JP Morgan was somewhat more of an opportunistic bet. When COVID struck, we were able to pick these things up under $100. As you can see, at almost $300, it's phenomenal performance. Not as good a dividend payer as you'd find out of the UK or the European banks, but really a very, very well-run business. They execute strategically brilliantly. And obviously just a big beneficiary, as you will see in this EPS DPS slide, a big beneficiary of US exceptionalism and a very enabling environment. Very interesting to see that the trend line of the earnings per share growth a lot steeper than for HSBC. I think this was around 15 or 16%. And as you can see, 2024 was a very good year, created a bit of a high base. And for that reason, 25 is looking a little bit more muted. And in fact, 26, 27 similarly. But really strong execution. And as you can see there, the 2025 earnings approaching $20, at almost $300, clearly on a massive premium to HSBC that we just saw. And, with a forecast divvy of a little over $5, also not anywhere near the kind of dividend yield that you're getting out of the likes of HSBC. Then on to BNP Paribas, really sort of this the third of the bigger holdings, and sort of really stressing the overweight banking position we have. Again, we're somewhat opportunistic. We bought them principally during the COVID sell-off when we were buying it at a price to book of less than half. It's run really hard, and as you can see from some of these key numbers, in spite of the rally, it's not looking expensive. A forward PE to December of 25, which is really just around the corner, of only around 8 times. The dividend yield at over 6%. With 10-year CAGR, apologies for that typo, 6%, obviously lagging the others, but still at a pretty decent discount to book, whereas obviously companies like JP Morgan trade on a factor of their book value. I'm not going to go through the numbers, but you can see total assets almost 3 trillion euros, customer deposits around $1 trillion. So really, this is a big company in anybody's book. Very good to see common equity tier 1 ratio at almost 13%. Then the iShares Ultra Short Bond Fund, really a corporate bond fund that we used as an alternative to cash. Our yields were so compressed. That jagged sort of sell-off you see is just really when the interest is declared on this instrument. A snapshot on from the fact sheet. Some 760 underlying holdings. As you can see there, the top 10 only represent 12% of the exposure. So a well-balanced portfolio. On a 1-year view, and obviously some currency issues here as well. 1-year view returns a little over 5%. 3-year also looking good, and the 5-year a little bit more pedestrian, obviously reflecting a very loose monetary policy world. As you can see, at sector allocation, banking around a third, but well spread across the other sectors, and as we would expect, very short-dated maturity breakdown with an effective duration of 0.4 of a year. Then on to Shell, again, somewhat opportunistic, buying it during the COVID sell-off. It's been a really good performer, from buying it around £10. We've taken some money off the table. So, if you add the divvies back, and this is a highly cash generative business, it's really been a great performer. And we are very happy with that, but recognize the need to offload a little bit in Shell. Then moving on to Micron, it's been quite a volatile one. We fortunately bought them quite some time ago, actually a few years before COVID, and that worked out quite well. So from sort of $40 to 123, and some we might even have taken off the table a little higher than that. Very encouraging to see the good performance. It's been quite a volatile model over the last while. Obviously, the Biden administration put those technology curbs in, towards China. That hurt them very hard, very significantly in 2023, and spilled over into 24. You can see things starting to normalize now. But it's been a fairly lumpy one, but it's good to see, 25 earnings rebounding, and the forecast for 26 and 27 also looking encouraging. But it does remind you that this is in a volatile sector, and it's somewhat of a football in the China-US tensions. Then a company that I would say we're a little bit lucky on, but the investment hypothesis was effectively a technology that was highly annuity driven, with a lot of the new sort of almost utility type of underlying technology exposure. But with back when we bought it, obviously cloud and Azure being a big appeal. But more recently, of course, the market has really gotten very excited about the AI prospects, and really that is what has triggered this massive run post the Liberation Day sell-off. We still like the business very much. But if you look at the earnings, you can see, in spite of a 10-year CAGR of 19%, phenomenal for a business of this size. We think the next, after 26's earnings are under the belt, we think that maybe 27 and 28 earnings are going to be a little bit tougher. But as you can see, for a business trading on, about $500, to be delivering $15 worth of earnings and paying less than $5 in dividends, the valuation is definitely stretched. So that's the reason we took some off the table. Nothing wrong with the business. It really just is the price that seems to have dislocated somewhat from reality. And we wouldn't be surprised to see it come up a little bit should that AI bubble either deflate or burst. Then moving on to the iShares US dollar Treasury bond ETF, really just tracking the duration of US Treasuries. If you look at that chart, it's had a nice rally over the last few months. We're slightly in the money, but we are, as we discussed in the big picture, becoming more anxious about the aggregate debt position in the US and the unwillingness of the politicians there to address the deficit. So it is our plan to lighten this exposure probably by about half, if we can see sort of 5% upside from here. And that would obviously just need yields to come off a little bit. Then GSK, this chart tells a very sad story, but what it is probably missing is the fact that Haleon was unbundled in this cycle. But you can see trading around 14 to 15 pounds, really telling you a story of a business that, like many in the pharma industry, people just don't enjoy. When we look at the earnings over time, if you look at the 10-year CAGR, it's not exactly blowing your hair back at 6%, but still probably better than what the market is rewarding them on. And as you can see there, in UK pence, probably going to deliver over £1.5. So at 14 pounds, looking very cheap, and also with the divi yield, that's also very, very compelling. So we think it's a defensive, well-placed pharma company, and one, unfortunately, that's been taken out with the risk of the most of the pharmaceutical industry. Then the iShares Agribusiness ETF, we did discuss this in some detail. You can see in the more recent past, this is the pound denominated chart. I apologize for that, but that the dollar one would have done even better. It really looks as though it's starting to kick into gear. Just some extracts from the fact sheet. You can see largely defensive consumer staples at 41%, and then materials at 37%, as you would expect for slightly more traditional businesses. Price to earnings at about 17 times, and price to book also not excessive. And although fairly concentrated, you can see the top 10 there, bottom left, representing over 50%. There's over 100 underlying shares in this portfolio. But it really looks to benefit from that theme that we believe is going to be one of ongoing pressure due to climate change and a few other factors in agriculture, and that agriculture will become more technical, more scientific, more capital intensive, and more professional. And obviously those companies that make up this index are beneficiaries of that. If you look year to date, done really well, almost 14%. On a 1-year view, up about 9%. But you'll remember we haven't held this fund for awfully long, so quite encouraging to see it performing, particularly in dollar terms. Then Diageo, that graph paints a fairly sad picture. We've held it for quite a long time, and for a long time we looked like heroes, having paid probably 18 or 20 pounds, went to about 40 pounds, and you can see the sort of steady derating, basically from just after COVID, although it in large part I think is a factor of the some missteps and some difficulty in Central America, particularly in the Caribbean operations, that hurting them. Maybe some question marks over, the Gen Z being very cautious in their alcohol consumption and particularly mindful around high-calorie alcohols. So that's maybe a long-term strategic consideration, but we believe that, as that chart suggests, if you look over 10 years, although it hasn't been spectacular and there have been some difficulties with COVID, for example, and the 2025 numbers were hurt by the Central American operations, we still think this is a great quality business, a fantastic portfolio. As you can see there, with the share price at about £20, with forecast earnings for 2026 at almost £1.70 and a dividend of around £1, just over £1. Both the PE and the dividend yield look attractive for what is really a good quality business. Then moving on to the iShares MSCI China ETF, we spoke at length in the big picture about the fact that China, India are going to have to be the engines for growth globally, and this fund really just looks to position ourselves and our clients for that. As you can see, over a 5-year period, not that we've held this anywhere near that long, the China A share index has been very disappointing, but very encouraging to see from when we bought it probably about 18 months ago. This fund is starting to look a lot more constructive. A couple of the extracts from the fact sheets. You can see financials actually a little awkwardly for us represent almost a quarter of the index, but information technology, and then a good balance across some of the other sectors. And even in the top 10 holdings, it's only top 10 only represents around 20%. The total number of holdings 395. So although you've got a fair amount of banking exposure and some insurance in the top 10, also very encouraging to see things like CATL, Quaychow, and BYD also in there. Then you can see on a 1-year view, 20% return. 3 years still disappointing, but we remain positive on this. And you can see there the average price to price earnings at just under 16 times is not too demanding. Then just a little bit more on that chart, you can see in US dollar terms over the last year, really kicking into gear, particularly in the last few weeks. Then Prosus, not going to talk too much about it. It's really a proxy for Tencent, which has obviously recovered quite nicely. But obviously in the last while, this is obviously the euro chart, this being the offshore portfolio, whereas the rand returns have looked a little bit better. But you can see, actually, all things being equal, Prosus has not delivered the kind of returns in euros as might have been expected. So nice recovery from the end of 2023, but yeah, still trading at around just over 50 euros a share. Then Volkswagen, it's one of those that we must confess we misread. We thought they would be a beneficiary of the switch to electric vehicles along with BMW, but frankly misread just how important it is to build electric vehicles from the ground up, as we've seen from Tesla, BYD, and more recently the likes of Xiaomi. So, but I think if you look at the actual results over the last 10 years, obviously 2015 year was courtesy of Dieselgate. You can see 24, I think particularly as a result of the Chinese operations, but you can see in 2025, in spite of what's going to be a difficult financial year, still trading on a forward PE of under 6 times and a forward dividend yield of 5.1. And then you can see consensus is for 26 and 27's earnings to recover. So in our view, it's definitely not a sell. I'd call it 100 euros. Obviously the boardroom battles haven't helped, but something's got to crack here. And we believe that the board's plan to switch to focus more on profitability than sales will probably help propel these earnings forward, in which case, this could see much better EPS delivery over time. In BMW, similar sort of story over 5 years. It hasn't been a great performer. obviously caught in some of the same headwinds as not only Volkswagen, but a lot of the traditional automakers. But it has recovered quite nicely, particularly from that Liberation Day sell-off, where it traded down to just a little over 60 euros a share. So it's recovered quite nicely, but not a massive holding. But definitely surprising us in outperforming Volkswagen. Then Tesla, we have very limited client exposure to this, say for one or two clients that have a specific fondness for it. As you can see from that chart, really has been wild, all the way from $100 up to, $400 in 2022, all the way down again to just over 100. So very, very volatile. I think at the moment the jury is out. Sales have looked very poor for the car business. And I think increasingly there's a sense that maybe the Model Y, which has just had a bit of a revamp or a facelift, that those models are looking a little bit tired compared to some of the more creative Chinese brands. So we are anxious. The valuation of this one is actually the highest out of the Mag 7 by quite a way. Market's obviously quite excited by AI, and particular the robo-taxi opportunity. We think that it is still playing in a highly competitive space, and have some anxiety about the disappointment risk. Then moving on to GE Aerospace, obviously, it's been to hell and back, rallied really hard since the Liberation Day sell-off, done very, very nicely, but obviously still a lot of pain was caused by GE and the history of the conglomerate. But it is gratifying to see GE Aerospace recovering so nicely. Then Richemont, interestingly enough, when you look at it in Swiss francs, it's been quite disappointing. Obviously Liberation Day set the cat amongst the pigeons, then it rallied and it's come off again. I think in part because of their own results and guidance, but also I think there's an anxiety around luxury goods. So it's a good business, but it is a little bit more cyclical, as we've often said, than the share price reflects. Then Brookfield Renewables, the hypothesis was one of the capacity that they had, and the fact that more and more companies and governments would be looking to divert to clean energy. We still believe that hypothesis is true. You can see in US dollar terms it's done very nicely, obviously somewhat assisted by the weaker dollar, but it's good to see the recovery. But it's still early days, but it's one that we need to keep an eye on. Because between the depreciation and the interest bill, you do wonder when the earnings are really going to start kicking into gear. Then very quickly, we just wanted to introduce two companies to you. First one is Universal Music Group, ranked by Time as one of the 100 most influential companies. If you listen to music, chances are you listen to a lot of their artists and their catalogs. Some of the highest producing or highest sales artists are like Taylor Swift and Drake and Harry Styles and Ariana Grande are in their portfolio. A really good quality business who built an incredible portfolio of talent and music, but obviously more than just pure music, but very, very well placed in the sort of the digital content creation space. That's the share price. It's only been listed for about 4 years. It was unbundled out of Vivendi when they decided to become more of an investment holding company. You can see trading at around 25 euros. It is listed in Amsterdam. That's their headquarters, although their operational headquarters are in the US and in California. If you look at our assessment of UMG, we think it's a great quality business. Some of the best titles. Strangely enough, the digital music streaming evolution, things like Spotify and Apple Music, for example, are net positive for them. Although there's always tension, of course, between the content owners and the streaming platforms. There is a healthy respect and there's a symbiosis. So we believe net it's quite positive for them. It's a very, very highly cash generative business with very little debt. If you look at debt to EBITDA, it's 1 and a bit times, so really not excessive. We believe that there's a lot of scope for operating leverage meaning that maybe you could see 4, 5, 6% revenue growth translating into early double digits EBITDA and earnings per share growth. For South Africans, a 22 PE sounds extreme, but for a business of this quality, where we think it's probably realistically likely to deliver sort of 10 to 15% earnings growth per annum over the next 3 years, we feel that the 22 multiple is not demanding for a business of this quality, especially because there's a healthy dividend yield of over 2%, and we believe that the US listing is also very supportive. And then there's a good shareholder base between Valore and Vivendi, and of course, Ackman from Pershing Capital, who actually has this, if memory serves, as their single biggest investment at about 17% of the Pershing fund. So, there's some pretty serious people who share our optimistic view. Then just looking at the earnings per share and the dividends per share, decent trend there. You can see 25 earnings of around €1, puts it on a 24 times. If you look on a rolling 1 year, quite a bit less than, or a little bit less than that. And you can see there, a decent dividend payout as well. And we would expect that dividend payout, probably all things being equal, to increase because it's not an intensely capital intensive business. Then finally, just introducing PayPal. We probably all know it. We've used it. It's an online e-commerce platform or payment platform that services both customers, so it gives you the opportunity to hold money in a wallet and to transact safely in the e-commerce world, which has become a very, very big deal. But it also offers similar services to businesses and a whole lot of other related facilities. We believe they play a critical role in facilitating e-commerce and will continue to do so in spite of some headwinds and some technological developments in other parts of the financial services industry. You'll see in a second, when you look at the share price and the results, there seems to be a disconnect, and all we can suggest, and that's the reason we were drawn to it, is a good quality business with good outlook, good leadership that's delivering really solidly, but clearly it's fallen from that sort of highly rated tech label to being more traditional mainline, and that obviously triggered quite a big sell-off. We see this business somewhere between a fintech company and a financial services company, so parts of it look a lot like a Visa/MasterCard, but it also has, we believe, some other initiatives such as busy building crypto solutions and busy aggregating other payment platforms into PayPal Group, which I think could all be good long-term strategic drivers. If you look at that share price, it would tell you this business is broken. It's come down from $280 all the way down to $70. But we would argue that as the fundamentals are actually a whole lot better. Looking at some of the risks and some of the opportunities for this business, obviously DeFi and crypto could be a disruptor, but as we indicated, we believe that they could actually be a very important player in that space. Digital crypto wallets are notoriously risky, and we believe that they could play a very important role in helping people to secure those crypto holdings. Obviously, store cards, you've seen Walmart aggressively roll out, and there are obviously discount incentives to shoppers to use those cards, but it is crazy to think that every American or every citizen around the world is going to have 5 or 6 store cards. Eventually, there will be some friction, and we think ultimately they could also sit in the middle of that in that ecosystem. Could be some other new tech. Fintech is rapidly evolving. That could upset the apple cart, but we don't think that's real risk. We actually think the execution risk is actually the big one. Speaking of which, very young and energetic management team that have cast down some bold vision, but interestingly very focused on the profitability. So for them, the margin per transaction per user is more important than chasing revenue or transactions. We find that very, very encouraging. If you look at the valuation, around 13 times multiple for similar 13-14% profit growth. We think, a peg of one for this quality of business with the optionality, we think is very, very good. We think this business is very, very well placed, particularly with payment security and cyber risk in mind. We think it's a very solid business model that will continue to deliver solid CAGR earnings growth. And just a couple of those strategic initiatives could actually propel it. If you look at this, basically just bears testimony, really strong EPS growth in spite of that share price collapse. That, as we often say, has got nothing to do with the company. That's just everything to do with the market that probably misdiagnosed them or misclassified them. We think that this is the big opportunity. You're looking again for sort of mid-teens earnings growth off a 13 multiple. We think this thing is looking quite compelling. That is our offshore portfolio commentary. It was quite quick. We haven't gone into a lot of detail on any of the companies. If you've got any questions or comments or anything is unclear, please reach out to us. And we thank you for your time and attention.